I have with me someone who's a very interesting personality. Saurabh Jain of Stable Money is here with us. So, why fixed income?
There is very interesting story of Axis Mutual Fund has published saying that their fund has delivered 12%, but the customer got only 10%. Because people are entering and exiting at the wrong time. That's where we realize that there is an opportunity to create a fixed income investment platform. It's the largest asset class in India, but nobody talks about it because
it's not very sexy.
It's not very sexy.
I want to open a fixed deposit. I can just go to a bank and open, right? Why should I come to you?
The biggest problem is there are 25 crore people who invest in fixed deposit. 25 crore people have invested 75 lakh crore in fixed deposit. And only 1% of those fixed deposits earn greater than 8.5%. And on Stable Money, every deposit earns greater than 8.5%.
Which are the other fixed income products I can look at?
There's a new mutual fund category that has come recently, is an income arb fund. It's categorized or thought as a debt product, but it's actually an equity product.
It's kind of like, fixed income investing is always associated with your parents and your grandparents' generation. It's very cool to invest in stocks and equities.
Yeah. But you will be surprised, Sonia, that my median age of customers, and we have a 4,000 crore book on fixed deposit, my median age of customer is 28.
So you guys don't want to get into equities? Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset. Today is a very special episode because we're not going to talk about equities, which is our first love, but we're going to talk about fixed income and how you can invest in fixed income in different products. I have with me someone who's a very, interesting personality. Saurabh Jain of Stable Money is here with us. Saurabh, thank you so much for joining me on the Money Mindset.
Thank you so much, Sonia. It's a pleasure to be here. I've been a regular listener of this podcast. I've learned a lot on equity. I also thought that doing fixed income would be slightly off topic, but it could be interesting for your audience.
No, it's very interesting because, asset allocation is the most important thing for people. We constantly get fixated about equities, but I think investing in fixed income is also very, very important.
Yeah.
And Stable Money, for people who don't know, is a platform that helps you invest in fixed income products, whether it is in fixed deposits, whether it is in, corporate bonds, whether it is across the spectrum, right? So before, I'll ask you more about Stable Money, but
Sure.
before that, Saurabh, tell us a little bit about your journey as well, and how did you start Stable Money?
I started Stable Money almost 3 years ago, and but my entry into the financial market and into the fintechs is not very old. I think it's just 4 or 5 years, including Stable Money, is what I've seen this market. Before Stable Money, I was with Navi. We had an acquisition of SL Mutual Fund, which became a Navi Mutual Fund. So I was MD and CEO there, one of the youngest CEOs for a mutual fund time. So a lot of learnings happened because of that mutual fund journey. And before that, I was part of Swiggy, another startup. The idea, and maybe your audience, they are from multiple cities. A lot of cities beyond the top 7 cities. Launching Swiggy in those cities was my task. So that has been the journey for the last 6-7 years. But mostly most of my time was in Bombay and Bangalore. And startup or entrepreneurship is very close to my heart.
Okay, that's lovely. So you're still based out of Bangalore, right?
I'm still based out of Bangalore.
Okay, amazing. So why fixed income?
I'll tell you one very interesting story. When we launched Navi Mutual Fund, we realized that there is a wide space to be vanguard of India because there are 45 mutual funds that exist. And to do that, your product has to be very simple. It has to give decent return over a long period of time. And we thought that index fund, passive investment, is a great opportunity to do that. And there is nobody who was doing that because, for obvious reason, mutual funds were not focusing on it because it is a very low earning product. Other equity mutual funds and other products are very high earning product. Because there is no fund manager for index fund, the general cost is very low. So we said that that's a great opportunity. And we started working on that. And we launched our lowest cost index fund at a 6 basis point, where the next best was 30 basis point. I think Motilal Oswal. And when we launched, we were going through our NFO. And after 14 days of NFO, and we got a massive response, 100 crores in NFO, where the minimum was 10 crore. we saw that on the first day of launching the mutual fund, a lot of people started selling. And I was shocked, and then I started calling these people, because in startup there is so much of habit of just talking to customers constantly to get the feedback. And I started calling, and then these customers are saying कि sir ये तो NFO है ना, तो day one पे तो profit होता है, तो I sold it. And they confused NFO with IPOs. And that's the reality of the Indian market, where we are going and talking about 5.5 crore retail investors and all of that. But we have also been talking, there are months where the SIPs are, net SIPs are negative, there is no growth, people are withdrawing money. There is very interesting story of Axis Mutual Fund has published saying that their fund has delivered 12%, but the customer got only 10%.
I saw that.
Yeah, because people are entering and exiting at the wrong time. So I said that this is not the way it should happen. And what has happened in the last 5-6 years is that the markets had its best time. So you enter at any point in time, you always saw a positive return. And what it means to people is, you will always feel, everybody will feel that they are the expert, they know how it works. And then there are these events that happen, COVID happen, war happens, all of that is when you start losing all your money. And that's where we realize that there is an opportunity to create a fixed income investment platform. It's the largest asset class in India. But nobody talks about it because it's not volatile, it's not something that you can talk about, it's not very
sexy.
It's not very sexy. So we said that there is a great opportunity to build that, because there is a large mass who still believes in that, but they just don't go out and put it on the social media. So everybody feels that, oh, there is no fixed income investment remaining. So with that objective we started. We started with fixed deposit, because there is a very interesting analogy when it comes to wealth businesses. And this I learned at Swiggy, is that Swiggy had an opportunity to go from a 30-minute food delivery to a one-day Amazon delivery, where you increase your catalog, right? Or a 30-minute food delivery to a 10-minute grocery delivery. And we said that no, people have positioned Swiggy as fast delivery. You can only go on that dimension. So you can go only from a fast delivery to a faster delivery. If you do ulta, and we tried doing with Swiggy Minis, it doesn't work. And in wealth businesses, you can only go from a low return product to high return product. And that's how the real cross sell happens. You can't go you start with a very high return product and try doing a low return product. That will never work. And that's where we realized that fixed deposit is something that nobody's focused on. It's the largest asset class. You start with the lowest risk, low return product. Then you can start building on top of it once the customer is acquired. And that's where we started with stable money. It's a niche. We had a lot of doubts ourselves that whether this will work or not, because our primary circle doesn't talk about fixed deposits anymore.
So just to clarify, I want to open a fixed deposit. I can just go to a bank and open, right? Why should I come to you?
See, the biggest problem is there are only 1% of FDs in India. There are 25 crore people who invest in fixed deposit. 25 crore people have invested 75 lakh crore in fixed deposit. And it keeps getting 7 to 8% year-on-year growth. Now imagine that, and only 1% of those fixed deposit earn greater than 8.5%. And on stable money, every deposit earns greater than 8.5%. So there is the biggest problem was, there are banks which are offering higher fixed deposit, but they don't have access to customers, and customer don't have access to that bank. Right? Because these are MFIs which got small finance bank licenses and they exist in their particular state. They don't have opportunities to go outside that state because it requires a lot of capital deployment. So we said that we will build that digital channel to get these people on the platform, to get these banks onto the platform and marry them. And what is interesting,
so like an aggregator,
like a platform. And what has happened is, after Yes Bank fiasco of 2020, the DICGC insurance has gone up from 2 lakh to 5 lakh. And you must have seen in the last 3-4 years, you go to DICGC website and you will realize that every quarter or 6 months, you will see multiple banks are going bust, right? So there is a lot of awareness, unfortunately, with a different way about that there is a DICGC insurance. And now with DICGC insurance, every fixed deposit for every user in every bank is insured up to 5 lakh. Now that means that a 5 lakh FD at a 9% is as safe in small finance bank, is as safe as a 5 lakh FD at a 6.5% in one of the largest bank.
Okay.
So you make 2.5% more on the same fixed deposit without taking any risk. So that's the story that really worked for us.
Okay, amazing. So for me, I'm a purebred stock market lover,
Yeah,
right?
I know.
I have, I think 95% of my money is in equities,
Right.
and 5% is in fixed deposit. That also because my mother forces me to put some money there.
Yeah.
Because like, kal ko agar kuch hua to, agar, you know how it is, right?
Yeah.
Stock market tanks completely. So why should a person in their 20s or 30s invest in a fixed deposit when you are getting much higher returns, much better tax efficient products in equities or in other asset classes?
Yeah. So I'll answer it in two parts, right? There is a lot of human psychology is what we have realized in this. First is people like us talk about that there is no need of fixed deposit. We are better educated. We are better aware how markets work. So I'll start with my first salary into equity. But if you double down, you'll realize that a lot of people like this are not the first time rich. They have their family, their parents' entire portfolio lies in fixed deposit. So psychologically, you always feel that if anything bad happens in my early career, there is something to rely upon.
Yeah.
Parents ka paisa hai, they'll back. Somebody else will back me with this. But a large generation in India is become first time rich, right? Where they have seen a very struggle time with their parents. Parents don't have so much of savings. And they don't want to go back to that time. And that's why it becomes very important to have that fixed deposit. And that's why a lot of people still do fixed deposit as part of their portfolio. So that is one, that somebody says that they don't want to do fixed deposit. There are some other rationale that you don't think top of your mind. Second is, if you think about the overall situation, right? When there are job losses happening, when there is recession, when there is war, right? Markets will tank. You lose your job. There are some COVID, there is a lot of health issues and all of that. You need money. What you do? Because all your eggs are in one basket. You'll start taking out money from there. But market is already down.
Yeah.
A real investor actually invests at that point in time. Right? People have seen it at COVID time. And the real investor who is investing at that point in time has a great portfolio allocation. Because he has some capital which he can use in difficult time, which is kept in fixed income, right? He's using that and not taking out money from the capital market. But people like us who always thought that 12%, 18%, multi-bagger, all of that, we have kept all of that money, and you see there have been market crashes, and I've seen people trying to take out money, but everything is negative. So that situation shouldn't happen, because markets will always give you great return, right? But you will have to wait and have that patience and invest at the right time. And the only person who will be able to invest at the right time, who has a right mindset, and that mindset comes when you have safety net of fixed income. So that's how I have seen, at least initial days, I've done everything because the idea was to make quick money. But over a period of time, I've realized how people invest. Wealth protection is also a very important aspect.
No, I completely agree. And that's a part of asset allocation as well, right?
Right.
Which is, I think, the most important thing that youngsters need to look at. First, you need to do asset allocation, portfolio allocation, and then you need to decide, the next step.
Yeah.
So tell us a little bit about that. If you are in your 20s or 30s, what should your portfolio allocation look like? How much of it should be fixed income? How much of it should be equities?
See, I think everybody says that it's very individual call, and you'll have to do a very individual call about this. But I feel that there are standard rules in early 20s. When you are starting with your salary, you should start 40% fixed income. You should start 60% in a mutual fund or equity capital markets kind of business. So that's a good ratio. And as your wealth grows, this 40% should keep growing. There is a very interesting product which is in the US called Vanguard,
Yeah.
Vanguard has a very unique product called Vanguard 2050, Vanguard 2060, Vanguard 2030. And that 2030, 2040, 2050 means that Saurabh or Sonia will earn till 2040. So that's my retirement age where I'll stop earning. So what they do is you'll start investing from now. They'll keep increasing your debt portfolio as you reach 2030, 2040. Keep reducing your equity portfolio as part of that. But your wealth is growing.
I believe that's a great strategy where you start with a
40% fixed income, 60% equity, and over a period of time keep increasing that, and around maybe 30s or late 30s that can go up to 60 and 40 and then slowly reducing from there.
Okay, interesting. So, my main aim with this video is to educate the viewer about the different options that you have in fixed income.
Right.
FDs are not the only thing, right?
Right.
There are FDs, there are liquid funds, there are corporate bonds, there are arbitrage funds.
Right.
So I want to understand that if I have, say, some money lying, right? Whether it is a bonus that I got, an increment that I got, and I want to invest it in a fixed income product.
Right.
What are the different fixed income products I can look at, and in terms of returns, in terms of risk profile, tax efficiency? So we'll start taking them one by one.
Sure. So I'll tell you the first product that you should definitely think is fixed deposit, not because we are doing it fixed deposit, but that's the emergency fund. That's the fund that at any point in time you withdraw, you'll get the money next second. You don't have to question that. That's the safest money. And that is still giving you certain returns, right? And we'll come to why inflation beating is not the great point to think about that. But that's the emergency fund that you should have. It's generally 3 to 6 months of salary in any difficult time. But I feel that that is first thing that you should keep it. And that should not be your part of growing wealth. So that's one part of fixed income.
But there are two questions here, right? You spoke about inflation. I feel even taxation is a huge thing because once you cut tax and then you adjust for inflation, the returns on a fixed deposit are barely anything.
Yeah. So I think taxation is a problem, and taxation has become a problem with the debt mutual fund as well. And how we'll solve that is something that we'll talk. But when you think of an emergency fund, you think of that safety net. I think you should not worry about taxation. Yes, just try to maximize the return on your fixed deposit so that it's not just lying at a 5%, 4% kind of fixed deposit. And inflation as well. Honestly, Sonia, inflation we talk about, it's a 5% inflation, 6% inflation, and it's not beating inflation. But for people like us or people who are your audience, inflation is much higher. Look at the rate every year, the iPhone rate increasing, right? That's not 5%. Look at the prices in the restaurant, look at the prices of petrol. That's not 5%. So anyways, our inflation is much higher. Both, if you take that logic, multiple products, investment products will not be able to beat your inflation that you wanted. So think of fixed deposit as a safety net. It's the it's a basic principle that you should follow, that have some money in fixed deposit, keep it, forget it. You just use it when you want it.
So it's not an inflation beating investment. You should understand that at the start.
Yes, it's an emergency fund. It's the fund that you will use when you want it, and you know that this is the amount that you'll get. You are not worried about, you are not having multiple threads in your head saying ki wo paisa positive hoga ya negative hoga. That's the money that you want, right? And everybody has gone through, and I've seen, unfortunately, so many examples during COVID time by myself as well, that there's no money to take out from, and that's when you'll rely upon maybe your parents' fixed deposit or your fixed deposit. So you should definitely have that.
Correct. So
that is one part. Then second comes is the corporate bond, right? So corporate bond is one level above the fixed deposit, where the returns of a decently A-rated bonds is now somewhere around 11.5%, right? This is today's condition. This was 12.5 couple of quarters before, but now with the repo rates down, 11.5 yield to maturity is what you can expect from a decent A-rated bond. If you go for a triple A-rated bonds like, let's say, Tata Capital and all of that, you will get it around 8 to 9%, slightly higher than the fixed deposit. But unfortunately, even for bonds, it's fully taxed, right? So that's the next ladder, that you go up to 11 or a 12% corporate bond. I would sincerely avoid a triple B minus or a below rated bonds to do that, unless you understand the risk completely or the tenure is short. And in my head, and that's not the advice to anybody who is listening to this, is a risk of a triple A rated bond for 3 years is as low as a risk for a triple B rated bond for 6 months. Because what is risk? Credit risk is that what are the chances of this bond defaulting? the chances of a AAA rated bond defaulting, let's say Tata Capital, is very low over the 3 years. But similarly, our chances of a good BBB rated bond, and I'm not saying all, good BBB rated bond also defaulting in just 6 months is also low, right? Because some of those signs will start coming up, the credit rating will go down, all of those things would happen, right? So that's also one smart investing that you should do, that if I'm getting a good BBB rated bond for a 6-7 months, which is a 13%, and a AAA rated bond, which is after 3 years, which is at a 9%, I would have a good mix of this 13% and 9% both, because it's a similar risk, is how I see the bond investment.
So, which are the best AAA rated bonds currently, corporate bonds in the market currently, which give you around 10-11% returns?
There is no AAA which will give you 10-11%. Because the reason they are AAA rated is their cost of capital has to be low. So, everybody will be around 7-8%.
Okay, so let me rephrase that. Which are the best AAA rated corporate bonds which will give you 7-8% returns? Which are the top ones you would recommend?
So, we have Tata Capital is something that gives you 8%, 7.5 to 8%. And a very interesting part is the bonds have different, like you have a monthly, quarterly payouts as well. For anybody who is looking for a regular income from that, I think that makes a lot of sense for those bonds, that the capital principal is safe and you keep getting the interest regularly. But people like us should do bond laddering as well, that 6 months in a 13-14%, then 1.5 2-year bond which are coming at a 12%, you put some there, and the 3-year which is AAA rated, that comes at a 8-9%. So your blended take rate is slightly above 10%, but it's safe.
इतना time किसके पास है the bond laddering करने के लिए?
I'm just saying
that's why there are guys like you sitting.
That's where we are. Plus,
I think this is the best part of fixed income is you just have to do it once.
Sonia,
okay.
You don't have to just keep looking at your, where is the stock? क्या मैंने price पे hit किया था, क्या किया, नहीं किया. I think if you plan it once and do the investment, then you don't have to look at it. Like a lot of people talk about FD laddering, and what they do is, if you have, let's say 6 lakhs, I'm just taking one example, is they put 2 lakh in 1 year FD, they put 2 lakh in a 2 year FD, they put 3 lakh in a 3 year FD. Generally, you will see that the 3 year FD rates are the highest because of the ALM matches of the banks. And then when the 1 year FD is matured, you get that money and put it in a 3 year FD. When the second year FD gets matured, you withdraw that money and you put it in another 3 year FD. Then what you have after that is every year you are getting some liquidity, and all your FDs are locked in at the best interest rate, because generally 3 years is the best interest rate with every year liquidity. But people do that planning. It's just that people don't go out and talk about these things, because it's not a sexy thing to talk about fixed
income investing. Yeah, yes. It's kind of like, fixed income investing is always associated with your parents and your grandparents' generation. It's very cool to invest in stocks and equities or in cryptocurrencies, nowadays.
Yeah.
But I completely take your point that asset allocation and portfolio allocation is very important, because then when there's a rainy day and you need that easy access of money, and if there's a bear market, then, all hell breaks loose. You will be
surprised, Sonia, that my median age of customers, and we have a 4,000 crore book on fixed deposit, my median age of customer is 28. And 52% of my customers belong to tier 2 and tier 3 city. So it's not that a fixed deposit looks like a senior citizen kind of product. I have only 8% of my users who are senior citizens, and that too because of people like you and me who are going to our parents and saying, download stable money and do this. So it's still not so old school. It's still that 28, 29 kind of, it's not 21, 22 for sure. But yeah, that's there. That's the whole point, right? People just don't go and talk about it.
I think you have a huge potential in the senior citizen category, but the gap is that senior citizens find it very hard to use apps, you know, and for them, they need that one person who they can call and just harass the whole day. Acha, mera FD ka kya hua? Abhi iska redemption hai, At least I face that situation.
No, and that's the only reason that in this world of AI, we might be the only fintech who is saying that we'll have a dedicated 24/7 call support, where we have a team who is answering all the queries that the customer has around fixed deposit. And we are not only doing as a call support, we are doing it across 10 languages. because we know people will have, it's comfort when you talk in your own language, right? So you open stablemania, you will see Gujarati, Marathi, Punjabi, Bhojpuri, English, Hindi, all of that. So, and that's
Is it the Nandan Nilikani influence? Because when I met him, and I know he's an investor in your company, when I met Nandan the last time, he said that a big problem that we need to solve in India is the language problem.
Yeah.
Because every 20 kilometers in tier 2, tier 3 cities, the dialect changes. So he's solving for that. So
yeah. No, I think
could
it's not the
smell some of it there.
No, maybe I think we doing this has influenced him to invest. That could be the reason.
That could be the reason. Okay, getting back to the question. So you explained FDs to us, you explained corporate bonds to us.
Yeah.
What else? Which are the other fixed income products I can look at?
So there is a large part of investment comes as a debt mutual fund, right? So debt mutual fund has multiple products. You have liquid funds, you have ARB funds. There's a new mutual fund category that has come recently, is an income ARB fund. Right. So I'll start with liquid funds. Liquid fund is a standard that invests in T-bills. T-bills is issued by RBI. That's the safest product in India, right? The last product to default in any nation is the T-bill. So that's the safest product, and that's why that gives you low return. But interestingly, for liquid fund, what has happened is SEBI and mutual fund has worked, and they are giving instant liquidity on liquid funds. So there are liquid funds where you can invest, you get up to 6 to 7% depending upon the T-bill. But if you want to redeem that money, up to 50,000 rupees instantly will hit your bank account, because otherwise mutual fund redemption takes a day, or sometimes it takes 2 days to hit your bank account. But for liquid fund, any day, including weekends, 50,000 rupees per liquid fund, per mutual fund, you can withdraw instantly. So what has happened because of that is a lot of savings account money has gone to liquid funds, because in savings account you get 2.5 now, 2.7 is SBI. Liquid fund is 6-7 after taxation is still double than your savings account. And if you want, you can instantly redeem that money and use it wherever you want to use it, right? Because that's the benefit of savings account, that paisa jabhi bhi chahiye aapko mil jayega. So that liquid fund is used for that particular use case where you have to park your money for a short term. You know that you will need this money, or that's your liquid cash that you want to use at any point in time without breaking any investment. So that's the liquid fund. ARB fund is a very interesting product. What ARB fund does is categorized or thought as a debt product, but it's actually an equity product. Because what they do is in ARB fund.
So let me just rephrase this question. There are two things, right? There is an income arbitrage fund and a regular arbitrage fund.
Yeah.
I want to understand the difference between the
Yes.
two. And an income arbitrage fund is a new debt mutual fund product that has come out. So just explain the pros and cons.
So I'll talk about ARB so that income ARB becomes easier to understand. So
ARB is very simple. Most of the funds
buy particular stock on, let's say, one exchange and sell the same stock on other exchange. That's the arbitrage, because different exchanges will have different prices for a stock. And there are times when the ARB fund gives you great returns. When the market has a very high volatility, you will have great returns on ARB fund, because the arbitrage between the same stock in different exchanges will be high. And generally, when the markets are going up, you will see that ARB funds are giving higher returns. They give up to 7.8 to 8% kind of a return. And because it's an equity product, categorized as debt, because it's low risk, because you're buying and selling the same stock. It is taxed as an equity taxation of a long-term and short-term capital gain. It's a very interesting product that it gives you the same safety, but it taxed as an equity product. So our fund is also a product where generally between 3 months to 12 months, kind of a capital requirement that you have, people park it in our funds, right? And that is gaining a lot of popularity, right? I was in Kolkata, we are setting up our office there, and you go to a lot of these small businesses, right? Who you would think that they don't understand anything about mutual fund. And I was surprised to see that most of these people are putting their savings account money, a corporate bank money, into our funds, because they understand the taxation so well now. So there is a lot of penetration of that happening, and you will see that the inflows on our fund in the next couple of years will massively shoot up, because the taxation wise it's a great product. Now let's come to the new product, which is the income R fund. So what has happened is debt mutual fund initially was taxed much better, but in the recent budget, they have reduced and made the debt product as a similar taxation to your income slab. So debt mutual fund has become like your FD. So income arb, what they do is they invest some part of their investment into debt funds. And these are income arb is a fund of funds. So they invest in different funds. So they invest in the debt funds, which has corporate papers like AA, AAA, A, different products. And 35% or more is into arbitrage funds. Because 35% and more is into arbitrage funds and remaining is into debt funds, your taxation is a equity taxation. Your taxation is a arbitrage fund taxation, but you get a debt portfolio because you have remaining 60-65% into debt mutual funds. And that's the beauty, and that's the very recent product. There is very limited awareness about this product. So
why is that a good thing?
Because we are saying that 40% of your investment has to be fixed income, 60% has to be, let's say, equity. Now 40% में से आप थोड़ा FD कर लो, थोड़ा bonds कर लो, but you can still do that 40% through income arb, where you get the portfolio of corporate bonds or debt product with the low risk, but your taxation is significantly lower.
Okay.
So that's a good thing to invest in that product because you get your portfolio allocation, but with the lower taxation.
So if I have, say, a couple of lakhs, 1-2 lakhs, just, to invest somewhere.
Right.
And I want to park it for the shorter term in a product, income arbitrage funds is a good opportunity.
Income arbitrage fund is a good opportunity. That's short term because that will give you the taxation of the equity.
Okay.
Yeah.
Okay. Interesting.
Yeah.
Okay. What else apart from? So you spoke about income arbitrage funds, regular arb funds, which is in the debt mutual fund category, and liquid funds.
Yes.
What else?
So right now, there are a couple of products which we generally don't categorize as fixed income, but should be part of your portfolio is gold and silver. Silver, nobody talks, but gold is a great product. So gold, and we have seen the stories that how gold has given a 24% return in the last 1 year and all of that. But there were 3 key products that existed always in gold. One is the SGB, one is gold mutual fund, and one is digital gold. Right? Digital gold is very popular these days, we have seen. SGBs was the most interesting product, but now government has stopped it, right? So anybody who has bought it should hold on.
Government has killed it.
They just killed it. Yeah, they've killed it because it's the best product, investment product that you should have done. So if anybody missed it, they missed the opportunity, right? But after that, if you look at the gold mutual fund has a gold mutual fund of fund, which invests in the ETF of gold, is only 20,000 crores market across all the mutual fund. And if you include ETFs as well, I think it should be around 65,000 crores. It's significantly lower than ideally it should be, right? And the major reason is SGB was there. Anybody who wanted that gold exposure and is aware was doing SGBs and not doing gold mutual fund. And everywhere else, whether you go onto any app, you will never see gold at the top. You'll always see equity funds,
correct,
top 5, and the highest AUM goes there. When you go look at the distributor will always push for the equity funds because the commission is much higher there. Equity for gold is significantly lower. But now between digital gold and gold mutual fund, digital gold is not a great product. First, digital gold is not a regulated product. Second, it's not regulated by SEBI or RBI. Second is you have a GST on the digital gold. Third, there is a lot of price transparency issues on that. Let's say you buy 100 rupees gold today and you sell it today immediately. You will sell it at a 97.98. So that is the problem. That problem doesn't exist on the gold
mutual fund.
Right. And that is also taxed as a long-term and a short-term capital gain.
Okay, so I want you to explain gold mutual funds to me.
Yeah.
Now gold is at a very high price, right? So if I want to still allocate 10% of my portfolio in gold, how do I do it through gold mutual funds? Explain it to me like you would explain it to an 8-year-old child.
Yes. So if you want to put 10 rupees out of your 100 rupees into gold, and if you are doing it all as part of your investment and not as part of your jewelry is okay, you can't question that.
Yeah.
Other than that, the entire 10 rupees should go into gold mutual fund. Now, there are 2 products that exist in a gold mutual fund. First is gold ETF, which is an exchange traded fund, which you can buy onto the stock exchange between, let's say, 9 to 3:30 and buy at any point in time. And second is a gold fund of fund. which is built on this ETF, right? So when you buy a gold fund of fund, mutual fund, they eventually go and buy the ETF, right? Anybody who is active on the stock investment side and do a lot of stock investment, they should ideally put all of their money through ETFs. And I'll tell you why. Because ETF has an expense ratio, and let's take any AMC which has a ETF ka expense ratio, which is managing the cost of that mutual fund, which the money that goes to AMC that you pay from your returns. And that is a 30 basis point for a ETF, for example. If you build a fund of fund on that, you will pay for this 30 basis point. You will also pay for this mutual fund cost. So you eventually pay 30 plus, let's say the mutual fund is charging 20 basis point more. So if somebody is buying a gold mutual fund, they'll pay 50 basis point. But that same ETF, you can buy it at a 30 basis point. But it requires understanding. You need to have a demat account. You need to go to your exchange and trade that, right? And when you have to sell, you can sell it not on the weekends. You can just sell it during that ETF working hours and all of that. But if you are active on the stock market side, put the entire 10 rupees on the gold ETF. It will be cheaper, better returns for you.
So how do I do gold ETF investing?
You go on to your any broker that you have, let's say Grow, Zerodha, HDFC Securities and all of that, and you will find that there are Nippon Gold Bees and there are multiple mutual funds who have their gold ETFs live onto the platform.
So you pick any one, is it?
You should pick the one with two conditions. First is there has to be high liquidity on that ETF, because if there is no liquidity, you will not get the best price. Right. Generally, I have seen maybe Nippon, because this is the oldest gold ETF, they have a high liquidity. Second is you should look for the expense. Different mutual funds or different mutual funds charges different expense for the same, right? Some will charge low, some will charge high. So depending upon liquidity and their expense ratio is what you choose, and you can stick with it. Otherwise, underlying product is all same. There is no fund manager to that, so you don't have to worry.
Correct. And there's no moving in and out either, right? I mean, it's just one product.
It's just one product.
Regulated, yeah. So which are the top 3 or 4 gold ETFs that you like?
I personally do 2. I do Nippon gold ETF because it has a high liquidity and high volumes. And then I do Grow gold ETF because it has the low expense ratio. And I use Grow for my trading. So these are the 2 ETFs top of my mind. Others I have not seen, but there are multiple. There is SBI, there is ICICI. ICICI also has as a mutual fund. ICICI Prudential has the lowest cost gold mutual fund, not ETF, but the mutual fund, because they charge low on the ETF. They also charge low on the mutual fund. So the sum of these 2 is the lowest for the ICICI Prudential Gold mutual fund. So that's how you should see. But if you are looking through mutual fund, then don't just look at the expense ratio of the mutual fund, because sometimes you will see that a mutual fund which has the lowest expense ratio still charging you more because the underlying ETF has a significantly higher expense ratio. So look at the underlying ETF's expense ratio, look at the mutual fund expense ratio and do that. And I have done this study maybe a couple of months ago, the lowest was ICICI.
Okay, interesting. And if someone is in the age group of say 25 to 40, what percentage of their money should be in gold?
See, by the time you reach 40, it should be 10%. Now, there are 2 ways of doing that. First is you do SIPs and say that every 100 rupees I invest, I keep investing 10 rupees in gold at whatever price it is. Or
even if it's at the price that it is today.
Yeah, even if it adds the price, because what you will always see is, and that's very interesting thing that I have learned, that, and you can do your maths maybe from wherever you are, a 1 kg gold 20 years ago would buy you a house. A 1 kg gold today will also buy you a house. And 1 kg gold after 20 years will also buy you a house. Right? So the same
Not a house in Mumbai.
Not a house in Mumbai. But the 1 kg gold 20 years ago, if that is buying a house in Mumbai, maybe that.
In Panvel, maybe.
So that's the best inflation beating product. So, आप किसी भी price पे करो, you should not think of that as short-term returns, right? Because this price will go from 1 lakh to 90,000 or 80,000 or could go up to 1,30,000. But this price will keep going up. So that is one way. Or other ways, because you want to be opportunistic, what you can do is you can do lump sum investment wherever you think there is a right time. And let's say that I'm regularly not investing in gold, but I have invested, let's say, 1 lakh rupees so far. And suddenly I see the opportunities. Next 10,000 rupees, I'll completely invest into gold and make that portfolio as 10%. So that's on gold. I personally feel that silver should also be part of your portfolio. Only 2% of your portfolio should be silver. And these are all my personal investment strategies, not the recommendation.
No. I mean, fair enough. And I want to talk about silver because silver is a product that nobody talks about.
Yeah.
And very few, I mean, the large usage of silver is in industries, and
Yes.
that's why it's getting so much traction these days.
Yes.
Silver is used across industries, whether it's in semiconductors, whether it is in auto, but nobody talks about it.
Yeah.
Why is that? And what is the scope as an investor in silver?
Yeah, I think, nobody will talk because there are so many things to talk.
Yeah.
Right. So, and that's why nobody will talk, and that's still very small part of your investment. So, I don't think people will go and talk about it. And you should also not think a lot. Why I'm saying 2% is because it behaves like gold. You might get the similar or slightly higher or lower appreciation on silver. But because what you said, right, because of the industrial usage, the volatility in silver is so high. Right, you should not put more than a significant amount into silver, but that should be part of your portfolio allocation. Some people buy silver, keep it, but there is a storage cost. I feel that again, the silver ETFs are the best ETFs to do that. Again, for silver, I've done similar Nippon. Again, for volatility, but that should be 2% of your portfolio. So gold 2%, gold 10%, silver 2%. And let's say 40% on the fixed income side. That's how you should do it. 60% then you do equity, some direct stock, some mutual fund, whatever works best.
So you guys don't want to get into equities?
Okay, maybe the first time on the show I'm saying that we want to get into equities because we believe that the aspirations of my customers are there. They want to make money.
Correct.
The only difference in my customer and maybe a lot of people that generally you talk to, their full-time job is investment. My customers' full-time job is something else.
Correct.
They run their shops, they do their jobs, they're doing a lot of other things, freelancing and all of that. That's their job, right? And I'm attracting those customers that I will take care of your wealth in the way ideally it should be. So that the average return that you guys will get will be higher than if you do it on your own. So that you can focus on earning more money than growing money through wealth. And these people also have aspirations. And if we are able to build that trust, we'll be able to move the customers from fixed deposit to bond, to gold, to debt mutual funds, to eventually equities as well. Now, maybe our name will come against that you say stable money and then these products, but that's a good problem to have. But that's how we see that. Maybe not now, maybe 4 or 5 years down the line, but we want to offer the full stack service about the wealth to my customers.
So stable to unstable money via across the spectrum.
No, I'm just saying stable money to maybe just stable. That's the name that we would go.
But I mean, I'm someone who's been investing in equities for the last 15 years.
Yeah.
And I can tell you with certainty, because it's a use case for me, that equities it's magical with the power of compounding, right? And I was talking to someone yesterday who is a fund manager himself.
Right.
And he says that just because it was taught to us that 60-40 karo,
Right.
40% of his money was in fixed income and 60% in equities. And as a fund manager of equities, he's telling me, I wish I had put more money in equities than in fixed income, right? So I take your point entirely that it's very important to have a certain corpus in money that is predictable and stable.
Right.
But having asset allocation is also important. Like, for example, gold, right? I mean, if you map the last 10 years, the returns that gold is giving you far outweigh the returns of the equity markets.
Yeah. Like it's better than the 12% index fund what you get. And I'll tell you that difference, right? If your day-to-day and the fund manager's day-to-day job is this, I think in that case, I would still recommend that you can put higher allocation, 80%, 90% into equity, because you are day in, day out doing this. You know, you have learned the market, you have seen the cycle. But somebody who is a regular common investor, who is doing this with that aspiration ki yaar mera paisa bhi grow karega, they should have portfolio allocation. Otherwise, they will make terrible mistake of entering and exiting at a particular price in a stock or a mutual fund.
Correct. I completely agree with you 100%, because I do know that the first 1-2 years when you invest in equities, you're just buying volatility.
Yeah.
You're not buying returns.
You're right.
The real returns come after 5 years, right?
Yes.
So if you're buying volatility and you don't have the stomach for it,
Right.
like if you're a salary goer who earns maybe 20,000, 30,000 rupees a month, and you have to run your house, you have to pay your rent, whatever, and suddenly you see a fall in your money, right?
Right.
If you don't have the stomach for it, actually equities is the worst product to look
Yeah.
at at the start of your career.
Right.
So I completely take your point. And that's why my next question to you, if you are a 20, 25-year-old
Right.
who starts off, wants to build your wealth, initially, what should you do with your corpus?
Yeah.
How much of the money should you put in FDs?
Right.
How much of the money should you say, and within fixed income as well, how much should you allocate?
Right.
How much should be in insurance? Because I
Right.
think insurance is a huge piece that nobody talks about.
Absolutely.
So I feel step 1, emergency fund, step 2, insurance, and then equities, right?
Yeah.
Is that the right way to look at it?
That's the right thing. And I think if somebody would have told me go back to your early 20s and do things differently, I think I would do a couple of things differently. First is I would build my emergency fund, because I've realized my parents don't have that much of fixed deposit, which we can call it as a emergency fund, right? So I would invest in that, because I had invested a lot of money into capital markets because want to grow that money, and lost a lot of money. And as part of that, I lost my focus. I lost my first job. So then I realized, because your entire focus was on that, build your emergency fund. And let's say if your salary is 50,000 rupees, put a 3 lakh rupees as an emergency fund in FD. Once that is done, you do your life insurance. Most likely, if you are into a job, your health insurance is covered. A good thing that you can do is you can buy a top of health insurance. But life insurance is the first thing, because the sooner you get the life insurance, the cheaper it is.
The term insurance is
The
what
term
I-
insurance, yeah. And don't buy ULIPs and all of that,
Yeah.
or LICs. So term insurance is a great product for you to build on that. People don't realize its value. And by the time you are married, you have kids and all of that, you are in 30s, late 30s, you realize it. And the cost is significantly higher. Like a 10,000 rupees per year term insurance would cost you 80,000 rupees if you don't do it at the right time. So that is the second investment that you should do. Next, I would start putting it either through balance mutual fund, because you don't understand so much about the bonds and everything. So there are balance advantage mutual funds, which has some portfolio in debt, some portfolio in equity. So you can get exposure on both, because you are not able to spend so much time onto that. So you can do that, where you are saying that, okay, I have a slightly 40 to 60 ratio in those balance advantage funds by doing it directly into the mutual fund, where I don't have to focus on it. I think it's just as and when the wealth grows and you get into 30s is where the liquid funds and RF funds would start making a lot more sense, because I've seen an average ticket size of a large fund of liquid fund and arbitrage fund is 10x of the regular mutual fund. Because it's generally done by the people where there is a larger corpus. You want to save tax on that larger corpus, and you're okay with 1 or 2% slightly lower return, and you'll need that money sometime sooner. Till that time, I think in the younger age, I don't think you should think too much about liquid fund and R funds for that matter. Balance advantage fund is interesting. And if you find certain opportunities where you see that I can get a 12-13% great bond or anything, you can keep putting on to that. But I think balance advantage fund or some income R fund and the equity funds are the great products. And in equity as well, I give, because 80% of my equity investment is index funds.
Correct.
So try and do that. And you should also understand that, let's say if you do, and there are broadly 2, 3, right? Nifty 50, Bank Nifty, maybe Next 50, right? These are the 3 top you should focus on. Bank, Nifty 50 has a 40% already contribution of Bank Nifty, right? So you should assume that and put some mostly in Nifty 50 and then some part in Bank Nifty and maybe some small part in Nifty 50 is how I would have done my 60% of equity, 40% of debt.
Debt, okay. I'm a big believer of index funds, of passive funds. And I know a lot of my mutual fund industry friends may not like this, but I believe that over the longer term, no active fund manager can outperform the performance that passive funds give. And it's just a colossal waste of time, thinking about which active fund manager to follow, which active fund. I do active funds as well, but I feel over time, 15 years, 20 years, passive funds is the way to
Yeah.
go.
And I've seen people have 28, 30, when people show me their mutual fund tracking, and they have 28, 30, 40 mutual funds. Because what they have done is every month when they go, they see which is the top mutual fund that has performed in last month or last quarter and invest in that. Obviously, that will come at the bottom. You'll keep finding newer and newer mutual fund. You will never be able to capitalize on that. And a lot of things that we don't understand, it depends on the fund manager. It depends on his strategy.
It's human bias.
His human bias. That person might leave at certain point in time and go to something else. So those things you are not aware of, right? So index fund is the best way to do that. Give you 12 to 14% compounding return over a long period of time. You don't have to worry about it, and that's the cheapest, right? Even if you look at the other mutual fund versus index fund is the cheapest mutual fund.
It is. Yeah, it's a controversial topic, but I want to ask you, since you're now out of the mutual fund industry, you were with Navi and now you're out, right? What happens to this entire industry that's thriving on active fund management, right? Because in today's day and age, in every field, the human bias is being removed with AI, etc.
Yeah.
If people realize that there is just no need for an active fund, and people even know now that, PMSs, AIFs also are the same. It's the same thing, right?
Yeah.
I mean, these are products that really don't outperform.
Right.
Although the hype around these products is a lot. So what is going to happen to this entire industry?
Yeah. So see, initially there was a couple of
10, 20 years ago, the problem was there was a difference in the information.
Then what happened is people said, give me Wi-Fi, you and my information will be same now. So that talk after 10, 15 minutes. Now it says ki you and I have the same information, but you are more intelligent on how to use that information. So you have that advantage. Now with AI, that advantage is also gone. I will say that, okay, give us 10 minutes. I'll figure out with AI and we'll have the same intelligence. And what will happen, I believe, in next 10 to 15 years, and that's the same vision with which we have built Navi Mutual Fund, is that all the mutual fund investments will either go to index funds where they don't want to focus too much on of that investment. But with now no information and no intelligence arbitrage, if somebody wants to do active investment, they will not do active mutual fund. They'll do active stocks.
Direct stocks.
So that's how it will happen. So this active mutual fund will go away. It will be passive or it will be direct stocks. There will be nothing in between. And I believe mutual fund industry is realizing this.
That's why there's so much drain.
There is so much drain and there is so much focus to just maximize the inflow that is possible. Because people over a period of time will slowly learn this. In the last 4 or 5 years, you look at the number of DMATs, you look at the number of mutual fund accounts getting created. Because the market is good, everybody is happy. People will realize it over a period of time because there is no information arbitrage. There are so many people talking about this on the YouTube that mutual fund will most likely be
passive. Like even if you look at Zerodha, for example, they now have an AI tool on their app, right?
Yeah.
You can go and you can just ask the chatbot to just draw out a portfolio for you.
Yeah.
You don't need an active fund manager anymore.
Yeah.
And I know this is a very controversial topic because people, I mean, this is like $1 billion industry, right? Running on active fund management.
Yeah. No, I think you'll see that. You will see that into the mutual fund stock prices as well in the next 4 or 5 years, that the overall pressure on the expense ratio is also very high. As your AUM grows, you'll have to keep lowering your expense ratio. So the revenues will not scale as the AUM is scaling. And you should also see what will happen in the next 5 to 10 years. Everybody's talking IPO these days. All the companies that you see around will become IPO. There is so much of information available. Now you know about Zomato, you know about Swiggy, you know everything. That was very difficult to know about Reliance. Like even if you go and ask people about Reliance, they don't know. They have a lot of stocks. They have been investing for the last 10, 20 years. But real dhanda kya karte hai Reliance, you will be very difficult to say.
Correct.
कि जियो इसका पार्ट है या इसका पार्ट नहीं है, ये सिर्फ ऑयल रिफाइनरी है या कुछ और भी करता है. People don't know. But now the newer stocks which are getting added, people will know everything about them.
Correct.
And because there is no information, I think these people will do either direct stock, or if somebody doesn't have that much time, will do passive investment, which is the great thing to do.
Interesting. This is very informative, actually. Anything that we left out in fixed income investing? I mean, I think we covered largely a large part of it. But anything else you'd want to add where, people can look at different kind of products?
No, I think product-wise, we have covered most of it.
On the taxation side, you'd want to talk about anything? Because, I know for a fact that fixed deposits, taxation, inflation, all of that, if you take everything into consideration, it's not a great product. But when we discussed that it's not an investment product largely, it's more like a safety product.
Yeah. No, I think another thing which people should know, because I don't want to sell fixed deposit beyond an emergency fund need, is that in fixed deposit, your TDS is deducted every year, even if your FD is for the 5 years.
Correct.
Right. But with mutual funds, right, it is deducted at the time of, you are taxed at the time of redemption. So it will compound.
Correct.
In FD, if your interest rate is about 40,000 rupees or 50,000 rupees a year, you will be first, that tax will be TDS will be deducted. Then that remaining amount will be added to the next year's FD, and then it will start compounding. So that's there. And I feel that there is a lot of work also happening, because banks are also struggling to get the deposit on the innovation, whether the taxation should be better for fixed deposit, whether this TDS, and TDS has also gone from, I think, 40,000 to 50,000 rupees in this recent budget. So that is there, but it's a very different need, right? It's a very different use case of fixed deposit.
Okay. One final question before I come to, some last questions about you, etc. One final question on the government schemes, whether it's NPS, whether it's EPF, right, PPF, all of that. I want to understand from you, from your vantage point. Do you like investing in any of these schemes? Because I'm not a fan of the NPS. I know a lot of people recommend it as a product, but I'm just not a fan of that annuity component and all of that. But you tell me.
Yeah, no, I think wherever there is a restriction, I think you will always feel a friction, right? NPS, there is a restriction, but because of the taxation benefit and all of that, it's picked up really well. I feel of all the government scheme, PPF is a great product. I think I have 2 kids, and for them, I have done large sum of investment for the next 10-15 years, because it will give you 7.1, 7.5 tax free on the PPF. That's a great product over a long period of time, and that is government guarantee. So that's one product I personally prefer compared to all other government schemes that exist today. I don't know much about Sukanya Samruddhi Yojana because both my kids are boys. So I won't talk about that. But whatever limited I have read, I believe PPF is, I would stack rank them higher compared to any other product.
So what else do you invest? What are your other investment avenues for your kids? You do PPF, and what else?
PPF, I have done mutual fund investments, which are recurring investment that are happening for them. I have bought some long-term government bonds, which are 7-8%, but a 10-year government bond, which is again 100% guaranteed products. These are some of the investments that I'm doing. But I've learned one thing, and this is not the investment gyan, is that, and I feel that is true with myself as well, that I have an opportunity to save, let's say, 5 lakh rupees for my kid, so that this will compound over a period of time and he will get that money after a few years. Or I have an option to give him some experiences today with that 5 lakh rupees of investment. And that could be anything, right? I would prefer in doing that rather than keeping all the money for his future investments only. So I personally feel as a parent, you should also not just keep all the money ki yaar paisa aage jaake lagega. I think try and invest in giving some of those experiences to people. So to your kids. So I think that is one investment. So good part of that goes into that. And then remaining part goes into investment.
I've started something with my son. He's 8. And this was something a fund manager told me that he does with his kids. So I've started it and it's really working well. So I give him a sum of money every month, every couple of months to invest in a company of his choice, buy direct stocks. And the company should be something that he either uses or he has seen or he has experienced.
Right.
So far he has bought Maruti shares.
Oh, nice.
He has bought Colgate.
Nice.
He has bought Swiggy.
Oh, nice.
And these are all his discoveries, you know,
Nice.
because his...
It's good to know you are a Swiggy customer, not a
And,
Zomato.
and now he has, you know, his analytical mind has started working in that direction.
Oh, nice.
So when he uses something, he will ask me, is this a listed company?
Oh.
Is this so now Hyundai is listed, for example, and we
Yes.
have an i10. So he will, you know, he said, oh, now should I look at Hyundai? Now Hyundai versus Maruti comparison going on these days.
Right.
So I feel this will actually allow him to expand his mind
Yeah.
in that direction.
Yeah. No, and see, Sonia, I think this is exactly what happened. People will do this and your son will get into direct stocks.
Yeah.
If he's not doing anything else, or index funds, because now he's realized. वो बोलेगा कि अब मुझे पता है यार, अब I'm not giving any fund manager my money to manage whether to buy a Colgate or a Hyundai.
Correct.
So I think that's exactly what will happen. But this is something that I'll do. My son is also 8 years old, so
Yeah.
I'll start doing.
And it's a
that.
great age to actually empower more to, you know, I wish my parents had done that with me. I mean, today I wouldn't have to be sitting here. I would be sitting on some yacht in,
Yeah. No, but
Greece.
my mom. So my LIC, which was my mom started 20 years ago, expired this year, May 28th on my birthday, and I finally got 3 lakhs. And all of us are sitting and saying, "Ki kya hai ye?" But when she started,
Yeah.
I think at that point in time, 3 lakh was a significant amount. But I think that's how futuristic we'll have to start thinking, that this is not, these investments should really mean something over a long period of time. So yeah, so that's one. I every day morning at my place, at least, there is that CNBC Awaaz that runs. So he knows few stock, he knows Swiggy, he knows Heritage Foods. I don't know why. Some stocks he knows.
Yeah, of course.
But this I'll start.
It's a good one. It is. It's a good one. It also makes it's like a game.
Yeah.
Right. But Saurabh, it was so much fun speaking to you. Thank you so much for joining us
Thank
on the
you so
Money
much.
Mindset. I always like to end by asking 2 questions to every guest.
Okay.
One is any book recommendations, anything, any podcast that they love to listen to, anything international that they, you know, I mean, it's just kind of information or knowledge
Right.
sharing. And the other one is, what is the definition of money for you and what does money mean to you?
Yeah. So I'll tell you the book. I think it's not related to finance. It's the book that personally has helped me a lot. And I think for this generation, it will be very helpful. It's called Ego is the Enemy. I don't know if you have read that book. That's one book. And I am willing to send free copies to your audience if they put it in the comment that they want. There's that one book that I've given it to maybe 500+ people. And everybody
Who's the
loved
author?
it. Ryan Holiday.
Okay.
So it's a great book. So that is one book that everybody should read.
What does it talk about?
It talks about the internal ego and what are the different type of egos that you have and how it limits your performance, how it limits your potential. That's very amazing. And it talks about a lot of stories that in the past, in the history, how it has impacted different people. And we feel that ego, arrogance is just one thing, right? I don't like you, I'm better than you. But there are different type of egos that are there, and it's important to know that. So, so that's one book that I do. I think for me, money is the most important thing, because my childhood, I've seen that I realized that all the problems around my life and family were all because of money, because there's no money. So when I see people talking about money doesn't matter or money is not as important, I think they either have a lot of money, right? I feel money will not solve all your problem, but money will solve your money problem. And that's important to solve. If your money problem are solved, you are able to focus on some other things as well. So I feel that money for me is really the most important aspect of my life, because maybe of all the childhood that I've seen.
I second that. If you come from a humble background, you realize that money is actually the root cause of every problem. And the solution to every problem. 99% of your problems, at least. But Saurabh, it was great speaking to you, and all the best with Stable Money. I hope the next time you're here, it'll be a much larger book. You have a 4,000 crore book, you said. And one statistic that will stay with me is that there are, you said 25,000 crore is the...
So, FD, you will be surprised if you look at RBI data. FD is the largest asset class in India. 25 crore Indians have invested in FD. Every Indian has invested 1.7 FDs. It's the maths, like 25 crores into 1.7 are the number of FDs in India. and average FD investment per user is 3.2 lakh across this 25 crore index. That's a massive sum that is sitting into the fixed deposits.
Wow. And the 25 crore FDs
Yeah.
compares to what, 5 crore or 4.5 crore mutual fund?
Yeah, so
investment?
every year the new addition to the FDs, either because of the interest rate increase and new FDs coming in, there is a 6 to 7 lakh crore FDs getting added every year because some mature and they come back again. And mutual fund is around 2.5, 3 lakh crores. So it's still the largest asset class. It's just that it didn't get that much of prominence, tech innovation that it required initially.
Okay, all the best with
Thank
your
you so
journey, and thank you so much for joining us on the Money Mindset.
Thank you so much, Sonia.